Hi, I'm RJ Baxter of Fairway Independent Mortgage with your tip of the week. I want to talk this week about a common question that we get about credit and the effect that it has if a mortgage lender pulls your credit on your credit score. It's a common misconception that by having a mortgage lender pull your credit, it's going to automatically drop your credit score a whole bunch. And so I wanted to address that concern today. So it is true that if you get your credit pulled too much, that it's going to drop your credit score. Now, if you have a higher credit score, it's going to affect your credit less than if you have a lower credit score, because credit agencies, they look at someone with a lower credit score, no offense, as being riskier. So if you have a lower credit score and you get your credit pulled a bunch, it's going to bring your score down more compared to a person with a higher credit score that gets their credit pulled the same amount. The thing about it is that the credit models take into account the fact that you're going to apply for credit from time to time. So there's no set number of times that are okay to have your credit pulled, but they do understand that sometimes you're going to have to apply for credit. So how does this affect, or how does this translate to having a mortgage lender pull your credit? So if you have a mortgage lender pull your credit, and that's the only thing that you've had done for a while, and you don't intend to pull your credit again for another reason in the near future, then it's going to have very little effect on your credit score, if any. It's those isolated credit pulls that don't really affect the credit score that much. It's when you have your credit pulled for multiple different reasons in a short period of time that it's going to affect your credit score. So let's say that you apply for a mortgage, and then the next week you apply for an auto loan, and then you apply for a credit card the week after that. That is going to have an effect on your credit score, because the credit agencies, they look at that type of activity as risky, because in their eyes, you're taking on a lot of debt quickly. So that can be a risk factor. But if you just have a mortgage lender pull your credit one time and then you don't intend to do anything for months and months afterwards, it's going to have very little effect on your credit score, if any. The other thing that I wanted to explain is that having your credit pulled for the same reason within 14 days it only counts as one credit inquiry. So if you've had another lender pull your credit and then you talk to a second lender within 14 days, they can pull your credit and has the same effect on your score as that single pull. So it enables consumers to shop. So it goes for an auto loan or anything like that. You can have your credit pulled multiple times for the same reason within 14 days. It only counts as one inquiry as far as how it affects your score. So it enables you to shop for a mortgage lender. So that being said, if you're out there looking at this video and you would like to get a second opinion on what you're looking at with another lender, I would be happy to take a look at your situation, see what we could do. Rates are very competitive right now, and I would be honored to give you an estimate to see if we could match or beat what another lender's doing. So just give me a call if I can help out with that. Text me or email me. Once again, my name is RJ Baxter, Fairway Independent Mortgage. Have a great rest of your day.